So chapter 12, we're focusing here on shareholders' equity. Nope. So shareholders' equity, we all know, you guys have been dealing with this since the first day. It's just the difference between our assets and our liabilities, right? It's how much the owners of the company have a right to. If you have a lot of debt, the bank gets paid first. Your bondholders, right? We learned about bonds. The bondholders get paid first before us as owners do. So we're going to learn a little bit more about shareholders' equity. We're going to get into some of the nuances. So up till now, all the companies we've been dealing with have been corporations, and you're probably very familiar with the term corporation, but we're not lawyers, so what does it really mean from a legal perspective to be a corporation? Why do people do it? I think the first corporation in North America was the Hudson's Bay Company in like 1600 something. They were the first legal corporation, and since then there have been millions of corporations, right? It's really easy to do. You can go online to the Government of Canada website. If you Google incorporate in Canada, you'll be taken to a link from the Government of Canada website. You pay like $200 and they send you some paperwork to fill out, and you now have a corporation. You can make yourself the shareholder of that corporation. It's really just a legal structure. There's really nothing, it's just a shell, like a legal shell. There's really nothing else to it. So why do people bother to do it? Well, as I said, it's really simple to become an owner. So you can set up a corporation, but the great thing about corporations is that if you are the shareholder, you can transfer your shares very easily to someone else. You just need really a one-page document that says, I hereby transfer my shares of ePhone to someone else, and they paid me $100 per share, and that's sort of it, right? So it's really easy to transfer ownership. And it provides limited liability. So you'll see a lot of corporations called LLCs, which is limited liability corporations. So what does limited liability mean? Well, you've heard of people who sort of might slip and fall when it's icy outside on the sidewalk in front of someone's house. And they try to sue that person and say, it was your responsibility to clear your sidewalk. Because you didn't clear your sidewalk, I slipped and fell, I broke my hip, I can't work for the next year. So you've cost me at least a year's worth of pay, plus I have to pay all my medical bills, plus mental anguish. You've cost me like $1 million, right? And if you're the homeowner, the courts sometimes say, well, yeah, you did have the responsibility to make sure that your driveway was clear, or the sidewalk in front of your house was clear of ice, and you owe that person $1 million. If your house is only worth $500,000, well, what does that mean, right? Now you're bankrupt, right? You have to sell everything you own just to pay this person for all their damage. Now that's an extreme example. Canada's not nearly as litigious as the States, whereby everyone sues for everything. The famous case of the woman burning herself on the McDonald's coffee, and she won, like a massive multi-million dollar settlement. That stuff's kind of ridiculous, but it happens, right? So, a corporation limits the liability of the shareholders, meaning it's the corporation that gets sued, not the shareholders. So if we're all, let's say 10 years from now, we're all homeowners, or we have condos, we have jobs, and we also hold shares of ePhone. And ePhone gets sued for patent infringement by Apple. And let's say ePhone is worth maybe $1 million, and Apple sues us for $10 million and they win. And the court says, you have to pay Apple $10 million. Well, ePhone says, well, we don't, the company doesn't have $10 million, so it goes bankrupt. Apple cannot go after us as shareholders. It can't say, all right, each shareholder has to put in enough money so that there's $10 million in the company. So you're protected. And that's probably the biggest advantage of incorporation. If you hold shares, even personally, I mean, this is a real life example. If you hold shares personally if in your RESPs, for example, or in your TFSAs, if you hold shares of companies, you are not at risk of being sued for that company's behavior. So oftentimes the recommendation for any person running a business where there's even a remote chance that they could be sued, the recommendation is to incorporate, because then the corporation gets sued. Yes, you can lose, the corporation can lose all of its assets, but it's still better than you yourself being sued personally and being on the hook and having to sell your house and car and all that, right? So those are the advantages. That's why people do it. And corporations are, for the most part, easy to set up, as I said. they have to file their own tax return, so there's a bit more paperwork. So a negative might be paperwork. And record keeping. You have to keep really good records. But outside of that, having a corporation is highly advantageous. And if you ever start a business, you probably will incorporate and you'll need to go to an accountant to help you file your tax return. All right, so a corporation is called a separate legal entity. A corporation is, in the eyes of the law, a person, in quotes, person. That means that the corporation can own assets, it can incur liabilities, it can sue other parties and be sued, and it can enter into contracts. Same way that you and I can do all this legally, a corporation can do the same thing. And we've been seeing this since day one, right? This is nothing new. It just sort of gives some legal formalism to what we've been seeing. So shareholders' rights. So in Canada, we as shareholders have rights, and if we feel like our rights are being violated by other shareholders or by the company, we can take them to court. So this usually happens where, let's say we're all shareholders in ePhone, but one of us owns 51% and the others collectively own 49%. That one majority shareholder might be able to bully us, right, and take the corporation in the direction that he or she wants to take it, or maybe exclude us from important votes. But we have rights as shareholders, meaning we can vote. We can either actually attend the meeting when voting occurs, or we can vote by proxy, which just means we can delegate someone else to vote for us. And this will be voting for, usually, election to the board of directors. So who we want at the top of this company. And usually voting is proportionate. One share might equal one vote, right? Same as in politics. You as a person have one vote, right? No one has a disproportionate number of votes. But that being said, if it's one share equals one vote, if you own 50% of the votes, then, or of the shares, then you own 50% of the votes, right? We are entitled to proportionate distributions of profits or dividends. So, by law, if there are 100 common shares outstanding, and they're all the same common shares, the company can't say, I'm going to pay dividends to these 51 shares and no dividends to these 49 shares. You have to declare dividends on a class of shares, meaning you say, I'm going to pay $100 worth of dividends on all common shares. All common shares. And then that gets paid proportionally based on how many shares you own. Okay. Also, proportionate distribution of assets in a liquidation. So if the company, let's say ePhone's not doing well, either we go bankrupt or we just decide it's not worth our time, it's really not generating lots of money, we're just going to liquidate, we'll sell the assets, pay the debt, whatever's left we're going to distribute. Again, we can't say one shareholder gets all of it and the others get nothing. There's proportionate distribution. Now, there's a lot of other shareholder rights, but this isn't a law course, so we don't need to go into those. So we've been seeing this since day one. So the shareholders elect a board of directors, okay, and the board of directors then elect the president, vice president, VP marketing, VP finance, the controller, which is sometimes the CFO, right? The board of directors can be made up of, and this is the problem, you can have internal people, maybe your president as well, who sit on the board and who also appoint themselves to manage the company. That's clearly a conflict of interest, but it happens all the time. You can also have external, non-managers, okay? And these are usually preferred on boards because these external directors really have no vested interest in, being elected the VP of production, right? Or of the internal managers, of course, want a big bonus. And who decides bonuses? Well, the board of directors decides bonuses. They effectively decide their own bonuses, right? So external managers don't get bonuses because they're not part of the management team down here. So they don't really have any incentive to pay these exuberant, extreme bonuses, right? You want external non-management personnel on the board. So this is the basic structure for every corporation. All right, so share capital, you're going to see these words, authorized, issued, and outstanding shares. So authorized shares is sort of this universe you can see encapsulated by this oval, and that's just the maximum number of shares that can be sold. And you can set this to unlimited, so infinite number of shares. So as we saw in ePhone, if it needed to raise more money, it could just issue more shares, right? There's really no upper limit. So authorized shares can be split, this universe can be split into two sets. One is the issued set, and by definition, the remainder is the unissued set. Issued shares are shares that have been sold, and by definition, they've been authorized because they're a subset of the authorized share set, right? Unissued shares are the remainder. So if we had only authorized 100 shares and we'd issued 20, this would be 80. Now, where you have an unlimited number, you issue 20, you still have an unlimited number of unissued shares, right? I'm not that familiar with infinity math, but I think that works out. So then the issued shares universe can be further segregated into those that are outstanding. So these will be held, right? Held by us, by shareholders. Held by shareholders. And then there's what's called treasury shares. Treasury shares are issued shares that have been reacquired by the corporation. And in Canada, these shares are usually canceled. So what that means is the same way that ePhone initially sells shares to us to raise money, if it has a lot of cash in its bank account, it might say, I'm going to buy back some of those shares. Okay, so instead of us as investors giving ePhone money in exchange for shares, we sell the share back to ePhone. Okay, and then it just sort of puts it in the vault and never sells it again, or cancels them legally. So now you know that you can see sort of how the universe is broken up. You have all these shares have to be authorized, and then you have, this is the issued, and then issued is further broken out to outstanding, right? EPS, nothing new. I'm not really going to go over this again because we've seen it so many times. It's the most widely watched financial ratio. Means analysts, people who actually invest money, who control billions of dollars, look at EPS. Because it's a measure of profitability, and it allows you to compare companies across time and across other companies. Okay, so shareholders' equity has two main accounts, or two primary sources, and we've seen this also since day one. Retained earnings, which is just prior year retained earnings, plus net income, less dividends, gets us to ending retained earnings, right? This is the accumulation of all the profit, less dividends paid to date. The other category is known as contributed capital. And up until now, I've sort of skipped this, and I've just referred to common shares. I've just said the two sources of equity funding are retained earnings and common shares. So common shares actually falls into a category called contributed capital. Okay? And the reason why we break this out is because contributed capital actually has two components. It has common shares, and we're going to get to preferred shares later in this lecture. It has common shares, but it also has this thing called contributed surplus. We'll get into that as well. That's just a sort of, it's sort of an accounting anomaly, in that it's sort of like we didn't really know where else to put the credit, so we just sort of put it there. It's sort of like a placeholder. It's hard to really understand what it represents, but we'll get to that. So you can think now now that we're towards the end of the course, you can think of the two shareholders' equity accounts as being one, retained earnings, and two, contributed capital. And contributed capital contains common and preferred shares, A, but also this contributed surplus, B. Okay, so we'll get into that. Okay, common and preferred shares. So since day one, we've seen common shares, right? We know what those are. That's what ePhone gives to us in exchange for cash. We're going to get into how preferred shares work. So think back to the last lecture, and the whole theory behind bonds being issued at a discount or premium was that the coupon that they're offering is either above or below the market rate. And the market rate is determined by that risk-reward trade-off, right? Remember how we saw that diagram whereby we have risk here, which is increasing, and we have reward here, which is increasing. And as an investor, if risk is increasing, you expect to be compensated with reward. So this might be a 5% rate of return. So this is measured in percent, right? Risk is harder to measure in terms of units of risk. We'll just assume these are kind of unitless, or just sort of 1 unit of risk, 2 unit of risk, etc. Higher risk, higher reward. So you expect that if you're going to be taking more risk, you want to be compensated with higher reward, right? Why would you take this level of risk and yet only earn the 5%, right? Why would you ever be here? Well, you could just come over here and get 5%, which is what you want as a reward for lower risk, right? So, let's see if, okay. So preferred shares, the way they differ from common shares is that they get paid first. Rather, their dividends get paid first. So what does that mean? That means that if the company declares $100 of dividends, remember how I said all common shareholders participate, it's called pro rata or proportionally, right? But preferred shares actually gets to step in first and say, hey, you owe me $30. The rest goes to the common shareholders. Okay, so this might be the preferred dividend, and this might be the common dividend. Okay, so in terms of pecking order, who gets paid first? Historically, I've shown that first it's debt, then it's common shares, right? Debt gets paid in full first, and then whatever's left over goes to us, the common shareholders. So preferreds actually step in here, okay, and they're above the commons, but they're below the debt. So you can start seeing how the risk changes if you're the owner of these securities. Holding debt is relatively less risky than holding common equity, right? Because in the event that the company has a bad year, goes bankrupt, doesn't earn enough cash flow that year to pay all of its dividends, you as the debt holder will still get paid. Think of how a preferred shareholder might look at this. You're riskier than debt, but you're less risky than common equity. You know, if there's food rations, right, and there's 3 people in line and they're not really sure how much food is left, you'd rather be second than third, right? Or you'd rather be first than second. So preferred shares are relatively lower risk than common shares. Okay? But preferred shares don't have votes. So if you want to if you want to try to acquire a majority stake of a company or a significant influence in a company by holding maybe 25% of the shares, you need the votes, right? So you buy the common shares so that you could go to the meetings to elect the board of directors. Preferred shareholders usually don't vote. They don't have voting rights. The other thing is, preferred shareholders cannot force bankruptcy the same way debt can. So even though preferred shareholders get paid first for a dividend, the dividend is still optional, meaning the board of directors can decide to not pay a dividend and the preferred shareholders have no recourse, okay? So you can see how you have these elements of risk and reward, right? The other reward, or rather downside, is that common shares get the leftovers. Now that might not sound good, but if the company does really well, that all goes, so if company performs well, all that value accrues to the common shares. If the company prefers well, the preferred shares don't really get a lot of upside. The upside is limited in the preferred share case, but the downside is also limited. So if we were to look at this spectrum here, we might see this point here as debt. We might see this point here as common shares, and we might see this point here as preferred shares. Higher rate of return, right? Higher reward at 7%, but also higher risk. Okay, so common shares, we've said this all already, they have basic voting rights. The dividend is determined by the board of directors. And remember, there's no obligation to pay, right? The board of directors can decide what the dividend is. They can change it. There's no legal obligation to pay. And common shares rank below preferred shares. And we'll see why that matters in a minute. We're going to get into some examples of that. I'm not too concerned with what's called the par value of common shares. But that's sort of what we put in, right? Or the cash received for the shares. We've talked about this before. Shares can have an initial public offering. I think recently Snapchat had a big IPO, right? A couple years ago it was Facebook, Twitter, all these big startups that go IPO. And this is it's called initial because it's the first time a corporation sells shares to the public. Public being you and I, meaning any one of us can open a Questrade account and buy a share of Snapchat. Prior to the initial public offering, there were shares that were held privately. So it's not as if this company never had share capital. It was just that you and I couldn't access it. It was open to maybe private, institutional, high net worth investors. Okay. The second time or after a company issues shares, it's called a seasoned new issue. And this will be a subsequent sale of new shares to the public. We've seen this entry before, 100 times. On July 6th, BCE issued 100,000 common shares at $45 a share. So the journal entry is debit cash, credit common shares for $4.5 million. Now when shares sell in secondary markets, a secondary market being the TSX, the NYSE, these are all stock exchanges. When shares sell in secondary markets, there's no impact on the books of the company, right? The company might not even know, who its shareholders are day to day because they're changing, right? There's no impact on the company's books. There's no journal entry recorded if you and I trade our shares amongst each other, or if I sell shares on the TSX, or if you buy shares on the NYSE. Right? It doesn't impact anything to the extent the company isn't issuing new shares or buying back new shares or buying back existing shares. So shares can also be issued for assets or services. Right? We can, instead of issuing shares for cash and then using that cash to buy something, we can issue shares in exchange for a good or an asset. Right? We can pay our employees with shares. In this case, the example is a lawyer provides legal services to us. We don't have a lot of cash, so we'll issue shares to her. So the question is, what is the dollar amount? Do we estimate how much the lawyer would have charged us and then set that to the value of the shares? Well, the first place we look is the market value of the shares at the date of the transaction. Now, the market value is easy to determine if we're public. Easy if public. Because we can just go to Google Finance and say, what was the share trading at yesterday? And it might have been $5 a share, and we gave up 10 shares, that's $50, right? It's not easy if this is private. Because when a company's private, inherently, we're not really sure what the company is worth, right? Maybe we have estimates. Maybe we think it's anywhere between $1 million and $2 million, and therefore each share is worth anywhere, from $6 to $8. But we don't know what that means if it's 6 or 8 or 7, or maybe it's higher or lower. There's no real evidence, right? It's just sort of our gut feeling. So if the market value of shares can't be determined, then we estimate the value of the assets or services received. So in this case, if BC is public and we issue 10,000 common shares to this law firm for legal services provided, and the shares were selling for $15, we would debit legal fee expense for $150 and credit common shares for $150. As I just said, we can issue shares to employees for compensation. So sometimes bonuses are paid, some with partially in cash, partially in shares. If you're a startup, you might pay your employees heavily with common shares to incentivize them, saying, hey, if we go public, if we're the next Uber, Facebook, or Snapchat, you're going to make $1 million, right? So you might have also heard of this word called stock options. So what on earth is a stock option? It's a little bit different than just common stock or common shares. This is a little bit of finance. I'm just going to make some space here. A stock option. And many of you might come across this at some point in your career, so it'd be good to know. A stock option is the option, not the obligation, to purchase a share at a predetermined price. So what does that mean? Well, a stock option is actually a contract. It's a legal contract between two parties. In this case, it might be between the employer, BCE, and the employee. So they enter into a contract, and BCE says, I will give you the option over the next year, let's say 1 year, to purchase a share of BCE for $10. And let's say the current market price of the shares are $8. Well, that option is really worthless to you because, well, you're not obliged to purchase. There's no obligation to purchase this share. But what happens is maybe over the next 6 months, BCE does really well and the share price in the market increases to $15 a share. It's almost double. It's gone from $8 to $15. And BCE still has this contract with you whereby they gave you the right or the option to purchase the share at $10. You say, well, I can buy it from BCE at $10 even though it's worth $15. And you can make $5 a share in profit, right? That's a really good profit. And you're not really taking any risk, right? Because it's instantaneous. In fact, you might go to BCE and say, rather than us transacting in shares, just give me the cash difference. Just pay me $5 for each share. This predetermined price is called the strike price. Okay. Notice how this has value to you as an employee, right? You have a lot of upside. You don't really have any downside because you're not obliged to purchase it. But think of what were to happen if the strike price was set at $100 and the current share price was $8. What's the likelihood that the share is going to reach at least $100? in the next 1 year, probably very low, meaning the option's not very worthwhile to you, right? There's actually, getting a little off topic, but there's actually these two guys, I think they won a Nobel Prize, Black-Scholes. They developed a methodology for valuing the option, to say what is the option worth to you as an employee, given the time horizon before it expires, the strike price, where the company stock price is currently trading. It's a whole area of finance dedicated to options. So this is just the very basic, this is kind of options 101, but the important thing to note is there is some value to these, right? Even if you hold them, even though the shares might not be worth very much today, if over the next year or 6 months or however long the option is in existence for, if the share price appreciates above your strike price, you get paid out, right? So stock options are a form of compensation. All right, repurchased shares. Now remember, we saw this as treasury shares before. So a lot of Canadian corporations cancel repurchased shares, meaning they don't really hold them on their books. They just sort of buy it back from you or I or from the marketplace and just shred it and reduce the amount of shares outstanding. So BCE might reacquire 100,000 common shares, and it has to go to the market and pay the market price, right? The shares are trading in the market at $22 per share on May 1st. So they're paying in cash $2.2 million, right? This could be all from one shareholder, or they're just buying up whatever they can find in the marketplace. Now, the average share price of all the previously issued common shares is $25. So what does that mean? Well, when we had initially credited our common share account, right, when we sold these shares to the market, they were selling at $25 per share. So the original entry might have been debit cash, credit common shares for $2.5 million. Right? This might have been maybe a year ago. But since that time, the shares have fluctuated. One day they're up to 27, then they're down to 24, now they're down to 22. And when they're cheap, we decide to rebuy them. Right? If they're very expensive and we decide to rebuy them, we have to pay more cash. But we decide to buy back shares. Now, why would a company want to buy back shares? Just to, I mean, we're taking a bit of a tangent here, but why would a company want to buy back shares? Well, from your perspective as a shareholder, if there's 100 shares outstanding and the company's worth $100, each of your shares is worth $1, right? If there's 100 shares, if the company's worth $100 and there's only 50 shares outstanding, your shares are now worth $2 a share, right? So you as an existing shareholder, if you don't sell your share, let's say BCE goes out and makes a public message that says, we want to rebuy 100,000 shares. You might want to hold on to your share because you know that your proportional ownership increases a little bit, right? Because the denominator is decreasing. The number of shares, the pie might be staying the same size, but it's split into fewer slices, right? So everyone gets a bigger slice. So that's why companies do this. So let's say historically, 1 year ago, we issued these shares for $2.5 million of cash, and now we're rebuying them for $2.2 million. So you might think, well, let's just credit cash for 2.2 and debit common shares for 2.2. So here's the problem. Let's say that was all of the shares outstanding. How would our common share account look if we were to repurchase all of our common shares at a different price than we issued them, and we used the price that we paid as the debit to the common shares? Well, in this case, we would end up with a credit in common shares of 300 grand, but with no common shares outstanding. Now that's an extreme example because companies always have shares outstanding. But the accounting rules based on historical costs say you have to debit the common share account for the price at which they were issued, $25, right? Now we're only paying $22 a share in cash, The credit is this contributed surplus. Remember how I said that the contributed capital is the second part of the shareholders' equity next to retained earnings? And contributed capital has two components. One is the common shares and the preferred shares. And the other is this contributed surplus. So this contributed surplus is just a plug, right? And it just balances the equation. Now, if we didn't have this contributed surplus account, all that would happen was that our common shares would be overstated by 300 grand. Realistically, it doesn't impact the overall shareholders' equity because contributed surplus is a shareholders' equity account. It's just the allocation within that shareholders' equity. We're just moving effectively some of the value from the common shares account to the contributed surplus account. Okay, so let's say we buy another, let's say this transaction occurred, right? And then we buy another 100,000 common shares, but this time at $29 per share. Okay, the rule still holds that we care about the average price of the issued common shares, of the previously issued common shares, meaning what did we get for them when we originally issued them? We still care about this $25. Now, so this is the reverse. This is the other side of that transaction. So how much cash are we paying? Well, we're paying $29 a share, so cash out the door is $2.9 million. Our common shares are still only being reduced by $2.5 million, 100,000 shares times $25 per share, which is the issuance price, right? Well, we still have $400,000 to balance. So what we do here is contributed surplus can never have a debit balance, okay? We can debit it to bring it to zero from a credit balance, but we can never debit it to put it into debit territory. So here, contributed surplus went up to 300 grand, and now we're bringing it back down by 300 grand, such that it's now zero, and then the remainder of the debit comes out of retained earnings. Okay, if we historically had no contributed surplus, let's say this previous transaction never occurred, this transaction would just be retained earnings, debit 400,000, okay, and we'll just assume that this never happened. The thing here is the whole point of this is that the cash out the door doesn't have to match the change in our common shares. Okay, we want the change in common shares to be based on the issuance price for those common shares, and we need to plug the difference somehow. If it's a debit, it first reduces contributed surplus to the extent that there is any contributed surplus. If there's no contributed surplus, the debit goes to retained earnings. Okay, all this is just a reallocation in that shareholders' equity account. Notice how the shareholders' equity balance is still getting debited by 2.9 million, regardless of how we allocate it amongst those accounts. But the thing is, we're trying to convey how much of the value in the shareholders' equity is attributable to the common shares versus the retained earnings, versus this contributed surplus. It gives some valuable information to investors. Okay? So dividends, we've been seeing this since day one. Dividends are declared by the board of directors. They create a liability at declaration, meaning when dividends are declared. They're not legally required, meaning the board can never declare dividends. And the company needs to have enough retained earnings and cash to actually pay the dividend, right? So there's some important dates here. Okay? The date on which the board of directors legally declares the dividend is called the declaration date, and that is when we record the liability. The declaration results in the transaction. Transaction recorded. So on the declaration date is when we'll debit dividends declared and credit dividends payable. And we'll effectively move the value from shareholders' equity to the liability account. So there's a couple of other important dates. So up till now, we've seen this dividend declaration that creates the liability, and then we've seen the date of payment, right? The payment is, we clear that liability. We debit the payable and we credit cash, right? Something interesting, and this happens in real life, happens in between the declaration date and the date of payment. So let's say that the date of declaration and the date of payment are 7 days apart. Let's say you're a shareholder. Do you need to hold your share until the date of payment to receive your dividend? Or can you sell your share 4 days in and still get the dividend? So the answer is, it depends on what the date of record is. The date of record, the broker, so RBC, TD, any of your banks, Questrade, there's all these discount brokerages online now, they keep a record of what shares you held and when you held them or when you sold them, okay? So if the date of record is set at, let's call this, was there a date here? No, there's no date. Let's call this the month of July, okay? And let's say they set the date of record at the 22nd, meaning whoever held the share on the 22nd is going to get the dividend. The dividend is paid on the 24th. If you sell your share here on the 23rd, you will still get your dividend. It'll get deposited into your account because you were the shareholder as of the date of record. Notice how there's no entry, right? The company doesn't care who the shareholder was. The company's transactions are the declaration date and the date of payment. The date of record is what is the question of who the cash is paid to. And so the broker has to deal with who held the share as of that date. Make sense? The interesting thing is, so you might think, oh, great strategy. I'm going to hold my shares until right after the date of record and then sell them to someone. What you see in the stock markets is that the share price actually declines immediately once the date of record is closed, because that person who's holding that share is now getting a few dollars less. And you'll see the share price decline just a little bit. So you can't actually trade on that information because everyone knows it's happening. You can't really trick anybody on that, right? Dividend yield ratio. So the dividend yield ratio is used to compare shares across each other, and it's going to be the dividends per share in dollars divided by the market price. So if you think of buying a share, in this case, let's say the share cost $42.63 per share, and it paid $2.22 per year, you're earning about 5% in dividends every year. And you can compare that to how they've done in the past. They're hovering around 5%. You don't see Rogers only pays 3.5% and TELUS pays 3.8%. So on the sole basis of dividend yield, you might think, gee, BCE is a good buy. But remember, how do investors make money off common shares? One is they get paid dividends. The second is this share price actually appreciates. Rogers and TELUS might have really good share prices. Their share prices might have, if the share price appreciates by 5%, you've now made 8.5% on Rogers and 8.8% on TELUS. Let's say BCE doesn't appreciate, you're only making 5.2%. So you have to account for both the share price appreciation and dividend income. Okay, stock dividend. Now, this isn't what we've been talking about up till now. A stock dividend is actually a distribution of additional shares, not a cash dividend. What we've seen up till now is a cash dividend. Okay? A stock dividend is interesting in that all the company does is it prints more shares and distributes them equally. So let's say the company did an additional share dividend, meaning for every one share outstanding, they're going to issue one more share. So let's say the company's worth $100 and there's 100 shares outstanding. Each of us holds one share, and each share is worth $1. And the company decides to do what's called a stock dividend. and they're going to pay out another 100 shares, one to each of us. Are we any better off? No. Nothing's changed at the company level. They haven't received cash for these shares. All that's happening is they're just printing more shares, meaning now we each have 2 shares, great, but the company's, so there's 200 shares outstanding, the company's still only worth $100, each share is now worth 50 cents. Okay, so that's now it doesn't always happen in 100% increments. It can be a very small stock dividend, right? Maybe 1% of the shares outstanding or whatnot. But how it works is that each shareholder gets their pro rata or their proportionate share, so that everyone is still in the same relative position. So all shareholders retain the same ownership percentage. Okay, you retain the same ownership percentage. Look at the previous example. You owned 1 out of 100 shares or 2 out of 200 shares. No difference, right? You're still a 1% owner. It doesn't change overall shareholders' equity, but retained earnings actually does decrease. And I think there's a journal, I'll show you the journal entry. All that we do is we move value from the retained earnings to the common shares. Okay. So the question here is, what dollar amount do we decrease retained earnings by? And the problem is because we're not receiving any cash for these shares, we don't know what they're really worth, right? Well, if it is a small stock dividend, meaning less than 25% of the outstanding share capital, we go to the market and we say, well, if we're trading at $20 a share, we'll record this stock dividend at $20 per share. If it's larger than 25% of the total outstanding shares, we actually are going to use the average issuance price. Meaning we'll look to our books and say, well, historically, maybe the average issue price is $25. So we can see here, this still actually gets recorded as a dividend. Look at the date of declaration. Dividend declared, common, debit to shareholders' equity. That's the same account we've always seen. There's this temporary account called stock dividend to be issued. It's not a liability, it's shareholders' equity. The date of payment, when we actually issue the shares, we clear out this account and we credit common shares instead of crediting cash. So if you want to look at this transaction on a joint basis and cancel these 2 out, you have debit dividend declared, credit common shares. And this dividend declared, remember, comes out of retained earnings. A stock split is essentially the same thing. Okay, so you might hear words like a 2-for-1 stock split. So let's assume that the corporation had 3,000 common shares outstanding, book value of $3,000 before the 2-for-1 stock split. So total book value was $3,000, meaning this is the credit balance in the shareholders' equity. And there's 3,000 shares outstanding. Therefore, the average issuance price per share is $1. Easy. The company can just double the number of shares. The book value hasn't changed, right? Because all that's happening is they're just issuing more pieces of paper. Nothing fundamentally has happened to the company to increase or decrease the book value. Therefore, each share is worth 50 cents. Make sense? So you can see how there's a lot that can happen in the shareholders' equity account that doesn't even impact the overall shareholders' equity. It's just how we allocate it amongst the shareholders' equity. Does that make sense? All right, preferred shares. So preferred shares, as we've seen, have a preference. That's why they're called preferred shares over common shares, meaning they get paid first. No voting rights, which is a disadvantage. They usually have a fixed dividend rate. So they might be 3% preferred shares or 6% preferred shares. Well, what does that mean? We know that dividends aren't a legal obligation of the company, But if the company does declare a dividend, you know that the preferred shares will get paid first, and this tells you how much they'll get paid. Because if a preferred share had claim to 100% of the dividends, commons would never get anything. Right? So they have a preset claim if there are dividends paid. So this could be considered an advantage because you might want to know how much income you'll have. Dividends usually are variable. Dividends can change quarter to quarter, right? This gives you a bit more certainty. It's not 100% certainty, but a bit more certainty. You know that if there is a dividend paid, you get paid first, and you'll get paid, and we'll show you what the 3% and 6% means. It's of the face value, but you'll get paid a certain amount. So if you're confident that this company will continue to pay dividends, you don't know that the dividends might fluctuate between 50 cents and 60 cents, right? That's a 20% difference across 10 cents over 50 cents. But if you know that the company only needs to pay 20-cent dividend for you to be fully paid as a preferred shareholder, you're comfortable. You're always going to get your 20 cents a share, right? Even if the company fluctuates. As a common shareholder, it's much less certain how much you're going to get, right? If the dividend drops to maybe 20 cents a share, you still get paid out as a preferred shareholder, and the commons get nothing. Preferred shares also have some unique features, and this makes them very challenging to price or value, because for those of you who are in actuarial science, you'll probably learn all about these, but you're sort of now mixing all these different financial instruments, all these different options and warrants and rights. So sometimes preferred shares are what's called convertible, meaning if you hold preferred shares, they might be legally convertible into 1,000 common shares, meaning you can at any point in time say, I want to give up my preferred share to the company. And so you go to ePhone, you say, take back my preferred share and give me 1,000 common shares. They might be what's called callable or redeemable, meaning ePhone or any company that's issued preferred shares is allowed to buy them back from you. They can force you to sell them back at a predetermined price. And they might be retractable, which is the opposite of callable, meaning if we hold the preferred share, we can force the company to buy it back from us. And usually there's a redemption price, which is a predetermined price. This is very advanced stuff. This is like advanced finance. We're not going to go into how all these things look, but it can get very complex. Okay, so there's two, There's two types of preferreds, or rather, dividends can be thought of as dividends on preferred shares. Let me just clean this up so I can draw this. So dividends on preferred shares. So the way preferred shares, the way dividends usually work from a common share perspective is, it's really like it's really just a one-time deal. It's just a one-time deal whereby if the dividend is paid that year, great, you get paid. If the dividend isn't paid this year, too bad, you don't get anything, right? Just hope that they pay something next year. Preferred shares can be what's called cumulative, can have cumulative dividends rather, or non-cumulative. What cumulative means, and that comes from, to accumulate something, to build up something, means that if a dividend isn't paid in 1 year, the preferred shareholder is now above you in line for not only this year's dividend, but the dividend from last year as well. And if 2 years pass, now that preferred shareholder is entitled to 2 years worth of their dividends plus the current year before you get paid. So cumulative dividends are lower risk than non-cumulative, because even if you don't get paid this year, as long as at some point in the future the company's going to pay them out, you get fully paid out. Now, they don't pay you interest on that, right? Maybe it'll take 10 years to pay you out, but how it works is if you're a common shareholder and the company hasn't paid any dividends, and there are preferred shares, which are cumulative, that means those are accumulating dividends, meaning even if the company does pay a dividend one year, that's all going to go to the prefs probably, or a lot of it is going to go to the prefs. The non-cumulative preferred share dividend acts like a one-time deal. If they don't pay this year, then you don't get anything. It's just next year they get paid first. But there's no build-up from the previous years. So we'll see how that works. This company, Kites Inc., very creative, has the following shares outstanding. So there's 100,000 common shares. There's two classes of these preferred shares, right? We'll call them A and B. This first class of preferred shares is cumulative, and there's 5,000 of them, and we just see this $3. So in this case, this is the dividend. Now the alternative is, we could call this a $100 par and call it a 3% pref. And that, similar to your bond coupon, will be $3 per year. Okay, but here they're just telling you that the dividend is $3 a year. And then we have 3,000 shares of this other class of preferred shares, same dividend, but these are non-cumulative. Dividends were not paid last year. Okay, so what does that mean? Well, this cumulative preferred share has accumulated 1 year's worth of dividends already, right? The non-cumulative pref didn't get anything, and the common shares don't get anything from last year, right? In the current year, the board of directors declared dividends of 50 grand. How much will each class of shares receive? So this question is asking you, and this is, you can think of this as called a waterfall. And the reason is, we're going to pay out, there's a ranking here, right? First is pref cumulative. The second is pref non-cumulative. And the third is common. And it's a waterfall because it sort of goes like this, right? If the water runs out here and we're down here, we don't get anything. So we know that the total dividends has to sum to 50. And common shares is just sort of the remainder. If there's anything after we allocate value to the two classes of preferreds, it'll go to commons up to 50. So here's how we would solve this problem. We know the total is 50. Preferred shares, arrearage. So that's just last year. $3 per share, 5,000 shares. So this is last year. And this is this year. So the cumulative preferred shares are getting 30 grand. The non-cumulative shares are getting 9 grand. And so notice how this was calculated at 15, $3 per share at 5,000 shares. The non-cumulative, $3 per share times 3 grand. One thing to note here is, although we are presenting this as this class gets paid first entirely and then this class gets paid, how it actually works is this gets paid first, okay, and that leaves 35 grand left, and that's split equally between the current year preferreds, assuming that they're equally ranked. And the reason that's important is, let's say instead of this being 50 grand, let's say it was only 30 grand. Well, the thing here is, the prefs aren't getting paid fully, meaning we have to allocate proportionately. But the current year prefs share equally in the current year dividends. But first we have to pay last year's preferred shares. Does that make sense? So in this case, we have more than enough to pay out both classes of preferred shares, and the common shares just get the difference. Right, so notice how it's 30 grand to the first class of prefs, 9 grand to the next, and 11 to the common shares. That's 50 total. So this goes back to those dates. okay, to see if we understand what happens and when transactions are recorded on dividend dates. On June 1st, 2014, corporation's board of directors declared a dividend for the 10,000 outstanding shares of preferred shares. The dividend rate for the preferred shares is $2 per share. Okay. And will be paid on July 15th. So, declared. So this looks to me like the declaration date. And we know that we have to record a transaction there. We also know that this is the payment date. Okay. Which of the following will be included in the July 15th entry? July 15th is the payment date. We are debiting dividends payable. And that's because we're clearing the liability in this transaction, right? The declaration, so if we look at some of these other entries or options, debit dividends declared preferred 20 grand. Well, that's correct on the declaration date, but not on the payment date, right? That would have happened a month and a half ago on June 1st. Credit dividends payable, that's related to this. And credit preferred shares 20. So preferred shares actually show up on the books the same way common shares do. When you pay a dividend on common shares, you don't reduce the value of the common shares. Same thing goes for preferred shares. The preferred shares still sit on the books. This is their book value. Right? So we don't reduce the book value when we pay shares, when we pay dividends on shares. So you do not need to know this. AOCI, that's advanced accounting. Okay. Sometimes there are restrictions on the payment of dividends, and these will come in the from the bank in the form of covenants. A covenant is a promise to do something or to not do something. So in this case, the bank says, sure, we'll loan you 150 grand, but you need to maintain a certain level of retained earnings, and you aren't allowed to pay dividends. And this guy says it with a happy face, the big bank. So the reason they want to restrict the payment of dividends is because they don't want you taking out all the cash from the company, potentially putting you at risk of not being able to repay the interest and the principal, right? Nothing new here. Financing activities. So the issuance of shares is a financing activity and increases cash flow. And repurchase of shares or repayment or payment of dividends has a negative effect on cash flows. And this is all in the financing activities. Okay, so this is the last section of this. So we talked about the corporation a lot, and we've looked at how a corporation's books sort of operate using the shareholders' equity account. So what if you are what's called a sole proprietorship or a partnership? So so a sole proprietorship is really just you go out and start a construction business and people just pay you. They don't pay the company, you're not incorporated, you're just running your own little business. There's no separate legal entity, it's all you. Partnerships are a separate legal entity, but they're not incorporated. Okay. And a sole proprietorship is just owned by one person. Partnerships are usually more than one person. So the thing to think about here is there's really no difference in substance between what's happening. We just use a different name for the equity accounts. The reason is we can't call these common shares, we can't call these dividends, and we can't call these retained earnings because those are all concepts that relate to share capital. In a sole proprietorship and partnership, there is no such thing as share capital. Right? If you just went and started a business today and just started collecting cash as payment, there's nothing happening with shares. Like in the eyes of the law, there's no corporation. It's just you. You're just the business. So there's two equity accounts. One is called capital and the other is called drawings. Capital you can think of as the retained earnings and common shares, and drawings is dividends. We'll show you how that looks. January 2nd, Jay Doe started a retail store by investing 150 grand of his own money. Okay. All this happening, and so this OE is owner's equity as opposed to shareholders' equity. That makes sense. We don't have shareholders, we have an owner. Okay, but we're debiting cash, we're crediting this capital account for 150. All this is saying is Jay Doe has put in 150 grand to date. It's no different than when the company issues shares. Each month, Jay Doe withdraws a grand for personal living expenses. So how does this look? Jay Doe drawings. This looks like a dividend, right? And it's negative OE, and we credit cash. All that we're doing is keeping track of Jay Doe's equity account, how much equity he has in this business. And it's just the difference between what he's put in and what he's taken out. And the last component of it is this company, or this business, Jay Doe earned $18,000 and he withdrew 12 grand. So just like retained earnings, we're going to add the net earnings, meaning Jay Doe has $168,000 in this business and he took out 12. Therefore, his ending balance of capital is 156. So it's really the exact same thing in substance. It's just called something different because we don't have shares. So partnership functions, the accounting for partnership functions very similarly. Partnerships are, if you look at it from a comparison to a corporation perspective, it's easy to form. You and I can just get together and form a partnership. There's really nothing to it. The partners have complete control because there's no one else. We don't have shareholders in this business telling us what to do, who own it. We own the business. And there's no income tax. You might think, oh, that's a great thing, but all that happens is the income tax is paid by us personally, as opposed to by the corporation. You can't really escape taxes. The primary disadvantage is unlimited liability, meaning if you get sued, you have to sell your house, you have to sell your car, right? Whereas if you're incorporated, it's the company that gets sued. It's the corporation that gets sued. There is no separate legal entity in a partnership. So the entries here for owner's equity are the same, except we have more than one owner. So in this case, we have Abel and Baker. Abel contributes 60 grand, Baker contributes 40 grand, and therefore they decide to split earnings 60-40. So what we do is we actually keep separate track of these two partners, because if Baker is taking out more money every month, we want to know that Baker isn't entitled to as much cash as Abel is, right? But again, this is no different. All we do is debit cash, credit the capital accounts of the two owners. So in this case, Abel is drawing 1,000 and Baker is only drawing 650. So every month, Abel's drawings are debit 1,000, Baker's drawings are debit 650. We credit cash for 1,650. And then we have the partnership's total net earnings of 30. We have to allocate this. We have to allocate this 30 in the 60%, 40% split, right? There's the 40, there's the 60. So these increase the respective partners' equity accounts, and then the drawings decrease the respective partners' equity accounts. So we can see what the partners' capital balances are at the end of the year. Now this is actually pretty important because you'll see a lot of businesses are structured in this manner. There are tax reasons why you would do it, and you want to know how much capital do you have left in this business? How much could you withdraw from this business? Right? And it changes. You get an allocation of the income. Maybe you took no drawings this year, or maybe you took all your drawings this year. Right? Maybe you withdrew an extra 44 grand and you might have zero capital, whereas Abel still has 66 grand of capital, right? So you might come across this in your professional practice at some point. This is not important. I mean, this is kind of like a summary, but it's kind of detailed, so not too important. That's it for chapter 12. So I'll give you guys